with Broadwater-Toole Realty. Today I'm talking with someone that started my real estate career. He was my first lender in my first real estate transaction 16 years ago. 16, 15, we lose count. But I'm glad to welcome Matt Hunter with Assurance to our podcast. Hi, Matt.
Hey, how are you, Katina?
I am doing wonderful. Thank you so much for joining.
You're quite well.
I guess I just want to start out. I know a lot about you and I followed you. Tell our listeners.
Sure. So I'm Matt Hunter with Assurance Financial. We used to be Hunter Mortgage, and my mom started Hunter Mortgage back in the early 90s.
Wow.
It was time for her and my dad to start stepping back a little bit. And so I stepped forward in order to provide our clients with more available programs, technology, things that we just weren't able to provide as a small brokerage.
Right.
We've made the switch to Assurance Financial, which has been a really good switch over. And it's been great.
Good.
About me, I'm married, been married for 31 years. Got 2 grown boys. Just told you we got 2 golden retrievers, we got 3 cats. It's a menagerie at our house.
Absolutely.
So I am an engineer by training, which I'm not sure if you knew that.
I did.
Worked out at the site for 8 years, did environmental compliance, and really kind of felt the glass ceiling, so to speak. Young engineers, we like to change the world. You know, we like to do things that are impactful, and I thought I had some great ideas of ways to improve, and got pushed back from just everybody above me.
Right.
And felt like I needed to do something different. And because my mom had started the company, it was just kind of a natural thing. And I did it really part-time, you know, for the first probably 3 or 4 years, I was really just part-time. But then early 2000s, we had this refinance boom, and it just took over. And so I was working 2-3 days a week, and it became 5. And so finally, you know, went full-time. I've been doing this since 2000 and really enjoying it. It suits me better than that engineering field. So, you know, it's good for me. I feel like my mission is to create homeowners. It's not to originate mortgages. It's not to, you know, have so many closings a month. It's really educating and bringing somebody into the realm of being able to buy a home.
Right.
And so that's really what I cater to. You know, I love first-time home buyers. I love people that have questions. I want them to be educated. I want somebody to walk out of my office feeling like they are understanding the process and what it takes and the reasons why certain things have to happen.
And oh man, we have the same mission.
Yeah.
And I think every agent in this office has that mission. Yeah. And we start out really hungry. And throughout our travels through real estate, because you're actually in real estate, we find that the lack of education is humongous. And what people feel they can and can't do. I was talking to my daughter the other day, and she's on her first journey of home ownership. And she's like, I never thought I could get approved for a mortgage. I'm like, I'm your mom, you know, like, how did this happen? So thank you. I'm looking forward to this conversation.
Yeah, and it's, you know, so many people, they don't even understand really the basics of credit. And, you know, we sit down and we look at a credit report and go, oh, I wish I would have known all this back in high school. And I could have done a lot better. Back in high school, you're not ready to hear it. You're not ready to absorb that information to carry it forward. You're just really looking to get that diploma and get out the door. And it's unfortunate that part is missing from our education system.
It truly is. I actually asked King Lawrence in the last podcast that very question. What are we doing to prepare
Right.
our students for
Financial
life after
literacy.
high school.
Yeah,
Right, because that's the key.
it is.
So we'll go ahead and kick it off because
Yeah.
what's going on with these interest rates?
Oh, what's going on with the interest rates?
Yes.
It's being really driven by inflation.
Mm-hmm.
Inflation erodes the value of the dollar. And, when somebody takes a mortgage out, the investor is expecting to get a certain rate of return.
Mm-hmm.
And so when that rate of return goes down because the dollar is worth less,
Right.
in order to increase their yield, they're increasing interest rates. And it's all really being driven by the economy and what's happening with the economy.
Mm-hmm.
So we're seeing rates go up and up and up. And I don't know if you want to get into it now or later.
No,
okay, but
this is informal. They just want the information.
Yeah.
They don't care how it's delivered or in what order.
So right now, let's talk about the past. Okay.
Okay.
In the past, there is a spread of interest rates. So
Mm-hmm.
there's probably 20 rates that are available.
Mm-hmm.
And the higher interest rates generally have what's referred to as a rebate. Okay.
Mm-hmm.
The bank thinks that they'll make money at a higher interest rate and they're willing to give credit towards closing costs, called a rebate,
Mm-hmm.
that buyers then can use to offset what they need to bring to closing. Well, right now, every interest rate has discount points. Discount points are where you pay additional money up front
Mm-hmm.
to get a lower rate. And so every interest rate now has additional closing costs, okay? The reason being is that the investors believe that we are headed into a recession.
Mm-hmm.
If you look at what historically has happened during recessions, is interest rates go down.
Right.
So they're forecasting in the next 12 months we'll be in a recession.
Mm-hmm.
So interest rates are going to go down.
Mm-hmm.
The lender says, well, I'm not going to have this loan very long, so I want some money up front. So they're charging those discount points as money up front
Mm-hmm.
to be able to get what they would typically receive over a 30-year period.
Oh, wow.
And so that's kind of some of the dynamics of what's happening with rates and the reason why we're seeing them all having costs.
So your rates may look different from Bank of America rates or Guild Mortgage
Sure.
rates.
Sure.
Okay, so it's not constant across all.
It isn't.
Okay.
A lot of people hear the Federal Reserve raising interest rates.
Mm-hmm.
They don't control the mortgage rate. What the Federal Reserve can control is what's referred to as the overnight rate. It's the rate that banks use to lend each other money.
Okay.
That affects things like home equity lines, credit cards,
Mm-hmm.
those types of things. Okay.
Right.
But it's not a 30-year mortgage. Okay.
Mm.
And typically, if the Federal Reserve takes action to fight inflation and the investors believe that what they're doing is in the best interest of the economy, a lot of times, even though the Fed has raised rates, we'll see mortgage rates come down a little bit.
Got it.
Okay, and it all has to do with that big bad word inflation,
Mhm.
because that's eroding the value of that dollar.
Right.
So if they see that the Fed is getting inflation under control, then it eases their minds and they say, okay, well, we can raise lower rates because we anticipate inflation coming down.
And isn't this pushing some first-time home buyers
Oh, yeah.
out of the market?
Definitely.
Mhm.
I've got buyers that I pre-qualified last year,
Mhm.
last September. I had them qualified at rates that began with a 2. Now they begin with a 6. And
Mhm.
it's affected affordability. Some of my first-time home buyers can't afford the house that they thought that they were going to be able to buy.
Mhm.
It all has to do with the rates.
Yeah. Can we talk a little bit? You hit on it, the points,
Mhm.
because we have to buy down points, and a lot of people think a point is 1 point,
No. Well, it is 1%
1%.
of the loan amount, but it doesn't translate directly into 1 point in interest rate. So every rate has a price, and
Mhm.
sometimes you could pay an entire point and get your interest rate down. Right now, 3/4 to a half.
Mhm.
Okay, but it doesn't translate. It's not 1-to-1.
Right.
There are buy down programs that work that way, but in general, discount points are 1% of the loan amount that's paid up front in order to lower your interest rate by somewhere around 3/8 to 3/4.
Now, are there instances where you would not recommend a buyer buy down points?
So right now, because we do anticipate we're going to be in this recession in the next 12 months, the forecast from the smart people that know rates, okay, are saying they expect rates are going to be somewhere 4.5. So if you're at 6 now and you can get 4.5 in 12 months, then paying a lot of money up front in discount points really doesn't make sense, because you're never going to have that loan long enough to appreciate what you've spent up front.
Because you're going to refinance, hopefully.
Exactly.
Yeah, if you're smart, you're going to refinance, because that's 2 points, 1.5.
Yeah, definitely.
That can take your mortgage
Hundreds of dollars less.
hundreds of dollars less.
Yeah.
What's the difference between a loan officer, an underwriter?
Okay. Sure. So we all have our own wheelhouse that we spend time in. Me as a loan officer, my responsibility is really interacting with the client, getting a loan application, making sure it's complete, telling them what they're going to need to provide to us, things like pay stubs, bank statements, tax returns. That's kind of the front-facing part of the mortgage end of things. Processors and underwriters are getting further behind the scenes. So I've got a processor. Oh, I'm sorry, let me see. I've got a licensed loan officer assistant. Okay, her name's Kayla. Kayla is great. Kayla really interacts with my clients more on a daily basis to say, okay, well, I've gotten your pay stub, but I really need one more. Or I see a deduction on here. Can you explain what it is? And so we complete this loan file so that we've got a good, solid file. That's then sent to our processor. Our processor works further behind the scenes, and they'll order verifications of employment, they'll order the title work, the appraisal. So that's really the wheelhouse for the processor. Then the loan goes to underwriting. And an underwriter looks at the file and they say, okay, well, I approve your file, but I need a few more things. I see something on your bank statement that I need a question answered about. Is this an ongoing payment? Is there undisclosed debt that we don't see? Maybe you've got a tax lien and you've been making payments to the IRS. Well, we need to then count that in part of the debt to income.
Right. What's the difference between a brick and mortar bank and a mortgage company?
So brick and mortar banks, typically they're the bank, so they've got one investor, it's them. They offer one set of interest rates. They have typically what's called overlays. Okay, so underwriting guidelines say, okay, you need to do this, this, and this. The banks sometimes say, well, you do these other things too, which is beyond what the actual guidelines say. And so you wind up with a lot of nitpicky stuff really with a bank than somebody that's underwriting just to the guidelines, okay? We're somewhere in between the two. So we're no longer a mortgage broker. Mortgage broker, it became really frustrating for us because what we would do is we'd originate that loan and we would pick an investor and send it to them. We have no control over those investors. And if we needed to have a closing disclosure sent out early because we needed to close early or somebody was going out of town, we didn't have the oomph or the influence to be able to request that or to get them to do it. So we've moved to this mortgage bankers space where it's us. We are the team. So we are doing everything all together, okay? And our team is working towards getting that loan to close on time every time. And then you've got the banks that, like I said, they can be a little bit more nitpicky. Some have those additional overlays. And we find really comfort in this mortgage bankers space because we've got more control over the entire process.
And is it more relaxed than a client working directly with a brick and mortar bank?
So a lot of times when you work with a brick and mortar bank, you never meet the loan officer. they don't have anybody working in their local offices. They're typical loan officers. So you have to deal with somebody on the phone, which you never get to meet.
Right.
Sometimes you call up and you never get the same person twice.
That's
With,
true.
with us, it's me. I'm a loan officer. You're gonna see me. You know, if you want to sit down and talk, I'm available. Okay?
Right.
I'm gonna show up at closing, which you're never gonna see somebody from the bank show up at a closing because I want to be there from start to finish.
Right.
You know, I like this personal relationship that we form, and we're informal. You know, our office feels like home.
Right.
We are not stuffy. You don't have to wear a suit and tie to come in because I'm gonna dress like this most days. You know, I want my clients to be comfortable.
Right.
And there's a barrier there sometimes with a client that just doesn't feel like they can afford a mortgage or know anything about it. Going into a bank is a huge step for them, you know, because most bankers are going to come in, suit and tie, you know, you sit down and be very formal about it.
Right.
We are not. We are, I don't want to say informal, but we're very personal.
Right. And that was one of the questions that I sent you was, what does your customer service pipeline look like? You know, how do you interact with your clients?
Sure. So if somebody calls the office, the first thing they're going to get Margot. Margot is our secretary. And Margot is great. She's been with us for a long time. Very personal. I get compliments all the time on just how nice she is, how easy she is. You know, if you ever call in and I'm not available, you know, she's going to take a message and get it to me.
Right.
Okay. But that's always followed up with a phone call from me. I'll talk to the client. And again, you know, they can do an online application because we've got the ability to do that. If they want to come in and sit down and talk, we can sit down and talk. But there's a lot of personal interaction.
Right.
And then Kayla's been with us about a year. She came from the insurance industry. Very high touch customer service type of person. And she's been great. And she understands the process. She understands, you know, if we're looking for something specific, what it is that we need for underwriter or processor, just to make sure that we've got that solid file.
Now, what is the difference between the different loan products, and do you run the gamut on all of them?
Sure. So you'd ask about loan programs. There are typically 4 loan programs. Okay. VA, if the client has served in the military. USDA, great program, some strings attached to it. FHA, fewer strings attached to it. And then conventional typically is that person that may not be the first time home buyer, that is, you know, had a mortgage before, has had the ability to save up more money. Sometimes we get first time home buyers in that program, but not always. And so those are the 4 basic programs. Beyond that, there are other programs like construction or permanent loans, renovation loans. There are what's called non-QM, non-qualified mortgage loans. And those are things like bank statement loans, somebody that's self-employed. There's investor loans, there's foreign national loans. So those all fall in that non-QM space with all the new, I won't say new, all the regulations that have been put in place. You know, there's this qualified mortgage space, and then anything outside of that's now referred to as non-QM. It's like what's used to be the old subprime.
Now, what first-time home buyer programs do you have? Do you work SC Housing?
We do. So we've got SC Housing. We've also got what's called a Chinoa program. Okay.
I haven't heard of that one.
They offer down payment assistance. Okay. We had stepped away from the South Carolina housing program. They made some changes several years ago in their fee structure, and we weren't real thrilled with what they could offer. So somebody that is a first-time home buyer that really doesn't have the money for a down payment, a lot of times they're much better off going with the USDA loan, getting their first step into that house. You know, qualifying for USDA, 100% financing. You can have the seller pay the closing costs. They can essentially get into the house with actually nothing out of pocket. Okay, that's a great loan program, and that's really where we like to see a lot of our first-time buyers go, because that South Carolina housing, the down payment assistance, also the Chinoa program, it becomes repayable. And so you may not have a payment on it for 3 years, but then your mortgage payment jumps up on you. And we felt like it was really kind of unfair to a client to put them in that position. You know, even though 3 years from now, hopefully their pay will have increased, they can absorb that. But if you can get into a USDA loan with a 30-year fixed that doesn't change, you know, why wouldn't you go that way?
Right. Let's talk about mortgage fraud while we are looking at the loan products and explain to our viewers and our listeners what is that. And now I know how easily you can commit mortgage fraud. I don't think people realize that. Can you expand on it?
There's two really basic types of mortgage fraud. One is fraud for profit. And I don't think a lot of your clients are going to get into that. That is collusion between attorneys and appraisers and realtors, and it's a big thing. Okay.
Yes.
Personal mortgage frauds maybe a little bit easier than you could trip up and accidentally get into it.
Right.
But that typically involves something like you say that you make X amount of money. And really you don't, but you've taken your pay stub and you've doctored it up to make it look like you do.
Right.
It could be where somebody can't get a home because their credit isn't great, and they have a cousin that says, well, I've got great credit, I'll buy the home for you. And their intention is to buy that home as a primary residence, but never to live in it and let their cousin live in it. And so there's all these little ways that you can get tripped up, and it could be technically mortgage fraud.
Right.
And it doesn't happen often. I think I looked at some statistics yesterday. South Carolina wasn't really even on the radar as far as mortgage fraud. It's usually somebody like California, Illinois, Florida, where we're seeing these real estate deals that you look at and go, it just doesn't make sense.
That's not right.
Yeah.
So if we can just circle back to interest rates for a minute, just so that we can make sure the viewers understand what.
Sure.
I know there is an APR and there's an interest rate.
Right.
Kind of talk through that, because the one thing I get from my clients is, what are all these fees and what is involved in this, and why last year I could get a house for $300, this year I can only get a house for $200.
Right. So interest rates and APR, there's a difference there. So the interest rate is the rate that you pay the money back at. The APR is referred to as the cost of credit. And the way I explain it to my clients is, it's like you come to me for a loan for $100, and I say, hey, Tina, I'll give you $100, but I need $20 up front. So I give you 100, you give me 20, means that really I'm only out of pocket 80.
Right.
But I've set your payments up and I'm charging you interest on that $100. So I'm able to make a little bit more money back. It's certain that there are certain fees, like underwriting, processing, interim interest. There's some fees that are included in that calculation of APR.
Okay.
A lot of what throws the APR off is mortgage insurance. So PMI is figured into what that APR is, and so it makes it look like it's much higher because you've got that monthly fee going back to me as the lender. So your APR looks like it's a whole lot more than what your actual interest rate is.
Okay.
So the interest rate's what's used to calculate that monthly payment, and it's used to tell you whether or not you qualify debt to income ratio wise. Okay. The APR it was created for what they refer to as a shopping rate. So if you're looking at me, if you're looking at another bank, and you're looking at a third bank, and you look at everyone's APRs, it's supposed to help clients to be able to tell who has more closing costs or higher costs with their loans. Very few people understand enough to be able to utilize that. It's become a useless number, but it's still out there. It still confuses a lot of people.
Now, we typically use 3.5% here when we're trying to calculate the closing costs for buyers.
Sure.
We say, hey, put 3.5% as what your lender may charge you for closing costs, and that's what we try to ask the seller for.
Right.
For concessions.
Yeah.
Is that still a good rule of thumb? Is it higher?
Right now with the discount points, because they're, sometimes paying a full discount point, it's not always the case. And so you may need to go up to 4.5 or 5. If you can get 5 out of the seller, well, then they can use that additional money to get a better rate.
Right.
And it's not really money out of their pocket up front.
Okay.
So they're kind of building that into the loan. If I've got somebody that has, they found a house and it's $160,000 and they've got, let's say, $8,000 in closing costs. With home appreciation, the way it's been crazy recently, a lot of times they can say, well, I'm going to make you an offer at $168 and you're going to pay $8,000 worth of my closing costs. You'll still sell the house at $160. You'll get what you want out of the transaction, but I've been able to build my closing costs into it.
Right.
And so that's a lot of times in the past when it wasn't such a competitive market where we had multiple offers,
right,
it was much easier to negotiate.
Right.
The way things are now, at least we're starting to see things calm down and become more of a normal market. But it's so fast and furious that the sign didn't even make it to the front yard before that house was under contract. Now we're starting to see that slow down. We're hoping that is going to create more opportunities for our clients to be able to negotiate, to work the deal, to make it work for them.
Credit score. What is the lowest your office go for credit score?
So they say that you can go down to a 580. I've not had a lot of success at 580. What happens as a loan officer, like I said, I take that loan application.
Right.
I try to find the program that works for the client. And then there's an automated system that the files run through that generates an approval. Okay. So it looks at and does typically what's called a risk scorecard, where it looks at the risks associated.
Right.
A lot of times at a 580, you need to have a significantly higher down payment than what you would have if you had a 620 credit score. And somebody that's got a 580 credit score really hasn't managed their money well typically, and hasn't been able to save up money for a larger down payment. So have not had a lot of success from 580 to 600.
So your recommendation for any of your clients should be, it's going to cost you less with better credit than with lower credit score.
And that's what I do is, when I have a client that has a lower credit score, I'm going to kind of give them an action list. Okay, here's some things that you can do to put yourself in a better position. Because if you've got that 580 credit score, your interest rate may be in the high 7s versus getting a rate that's in the low 6s.
Right.
It's more beneficial to take a little time, get your credit right before you take that big step. Right. Like I said, it's my mission to get somebody into a home, but it's not the monetary part of it. Okay, I want to look out for my clients and give them good advice of okay, you may not be there quite yet. Here's some steps that you can take to get you where you're going to be in a better position to buy that home as a long-term investment.
And that makes a lot of sense, but my mind is going, you're dropping a lot of gems today, or nuggets, or whatever people are calling them now, knowledge. Your recommendation is not necessarily to shop lenders, but to look at the APR.
So the APR is, like I said, it's supposed to help you determine. Now, I'm going to tell you that there's probably not a whole lot of difference in closing costs between many lenders. So that APR it's not going to tell you a whole lot, So if you're looking at an APR and it's different by 1/10 of a point, there's really no difference between those lenders then. If it's significantly different, let's say they go online and they get a quote and, there's $10,000 worth of closing costs where, closing costs are $5,000 with me, there's going to be a fairly significant difference in that APR.
Right.
But for the most part, especially locally, if you're looking at different lenders, then the APR is not going to vary significantly.
Let's switch over to appraisers. Because I know the lender typically orders the appraisal.
That's right.
And we've had bottlenecks with appraisers lately where they're hard to to get out there
Yep.
and get the report back.
Yep.
Do you deal with one appraiser or do you deal with multiple?
So we deal with an appraisal panel. So we've chosen some appraisers that we know that we can place that order and get it back in a timely fashion. We know the quality of those appraisers. We know the kind of report that they're going to submit, that we're not going to have problems in underwriting, that somebody's turned in an appraisal that just doesn't meet the standards. So we have a lot of faith in those appraisers, and we try to limit that list so that we know that we get a good quality product up front versus somebody that comes in and just lowballs everything.
Right.
There are a few appraisers in town that are notorious for doing that. So they aren't on our list. Now, where we do run into problems is a lot of times with a VA appraiser. So the VA views appraisals very differently than most real estate appraisers. I've tried to talk to a VA appraiser to understand the methodology, and I'm not really sure how they do their appraisals. But in the grand scheme of things, the VA is looking out for their borrowers. And so they're very protective of their borrowers. And they want to make sure that that person isn't overpaying for the house. So if you're going to have a problem with an appraisal, typically it's a VA appraisal because that appraiser, again, is looking out for the veteran and they want to make sure they're not overpaying for it. So they'll invoke what's called tidewater. Tidewater is where they can't get that value up to where the purchase price is. And we've had several circumstances where that's happened. Some of them very relevant. I had somebody that was buying a home that was in a little subdivision. It was during the craze. They had a contract for over $200,000. But when you looked at the subdivision, you looked at the other homes that had sold, that had sold for $160. And the VA appraiser said, well, there's no rationale for this home to be at $200 when all the other homes are worth $160. So I'm going to protect the veteran, okay, by coming in with this tidewater. And tidewater is not the end of the world because they do give the agents, the realtors on both sides, the opportunity to come back and say, well, okay, can you reconsider based off of these other sales that may be more comparable to the property that you're appraising?
I had that happen, and I can't wait to have an appraiser on this podcast. I just cannot wait for it. And the house appraised under. The builder refused to lower the price to the appraisal price. Buyer refused to pay more. And they were like, well, if you just wait another week or whatever, we can, there will be some more closing and then we'll have the comps we need. But the buyer refused, I'm not waiting for you to do all of that. How do you take that? Because for me, in my mind, I'm saying, well, how are they appraising these other ones that's about to close? Appraisal is back, and this appraiser can't find constant support.
I will tell you that is not in my wheelhouse.
I know.
But appraisals, from my experience, they're very soft science. Okay, so when you get an appraiser, they're looking at comparable properties. So they're trying to find homes that are same size, same age, same condition, typically within the same subdivision. Okay, and you can have very wild variations from subdivision to subdivision even. But when you've got new construction and they're the first home to sell that is at that new higher price because of construction costs and everything else, that first home is always the struggle. And sometimes you will get somebody that has bought that home with cash, so that they can now use that as a comparable property because somebody just paid cash for it. They didn't care whether or not it appraised or not. Or it's somebody that may have had a problem with the appraisal, but they're willing to kick in to make up the difference. We've got some clients that are, very well suited to say, okay, I know the appraisal came in $2,000. I've got that money. I want the house. I'm willing to put that in. So now you've got a comparable property that's a little bit higher. And the appraiser's then able to use that as a close because a listing is kind of just a point in time. It's not a closed loan, and so they can't really use that as a comparable property to what the subject is.
Absolutely. Now we're going to shift to the credit repair companies.
Yeah.
I know that you have a lot of buyers coming to you and they have went and paid people a lot of money to get the credit fixed.
Yep, and it sometimes doesn't work.
It doesn't work.
Yeah.
And my recommendation to my buyers is why pay someone to do it when you can do it yourself?
That's right. You can.
What is your recommendation for
So,
that?
like I said, if I've got a client that isn't where they need to be credit-wise, I'm going to say, okay, here's some things that you can do. One of the changes that was recently made was that if somebody has a medical collection and it's got a zero balance, that no longer will be calculated into a credit score. So I've got clients that have $20 medical collections. You pay those medical collections off.
Yeah.
Make sure it's reported to the credit bureaus.
Yeah.
And then magically your credit score is going up because the medical collection isn't there.
Right.
And so there's a lot of things that someone can do themselves. One of the big things is they look at the balance on credit cards. So they look at credit utilization. Somebody that has a credit card that is maxed out, well, it looks like they're living off the credit card.
Right.
And so they're going to score lower if they've got a high balance on that credit card. So if you pay it down, then your credit score is going to improve.
Right.
And so there are baby steps that somebody can do in order to get their credit better.
Yes.
A great resource for clients is annualcreditreport.com. It was set up by the government so that once a year they can get a credit report for free from all three bureaus. And it actually allows them to communicate back to the credit bureaus, hey, I've taken these steps, here's proof, can you update my credit report? And so that's a huge thing that somebody can do on their own for free.
Right.
That's not going to cost them an arm and a leg, and they know what's happening with their credit because they get communication back from the bureaus. Okay, we've taken this off, and so you're making those steps.
Right.
Where those companies that they're paying, some $700-800, sometimes to do credit repair, they never know what's happening.
Right.
And they come in to me and say, well, this company's working on this. I'm like, well, it's still on your credit report.
Right.
Go and do it yourself.
Yes.
Take charge. Take the bull by the horns.
And just do it.
Yeah.
And that's what I recommend for my clients. They say, well, I just pay somebody, I don't want to deal with it. For me, and this is my opinion, is that when you do it yourself, you don't fall back into those old habits.
That's right.
Because you understand
That's right.
what you had to do to get there.
Yep.
So now let's just break down closing costs now.
Okay.
And we're coming up to the end, everybody, and I hate it because he's given us so much information, but let's break down some closing costs.
Sure. So typical closing costs, starting from the top, we talked about discount points.
Right.
Discount points can be a closing cost.
Okay.
You're probably going to have, typically an underwriting and a processing fee. Okay. We have an underwriting fee, it's $9.95, a processing fee of $2.95.
Okay.
Beyond those are things that are owed to us, that you pay us directly through the closing cost. Then you got third-party fees. Okay. Third-party fees are going to include your appraisal. It's typically $520. Credit report, somewhere around $55. We do what's called an undisclosed debt monitoring because we have clients that go out and buy a car in the middle of buying a house, and that throws off the debt to income ratio. So we've got a service, it's only $17, but it informs us as we go through the process if there are new accounts that have been opened that then we need to go and get a statement on, or try to find out what the balance is, what the payment is, so that we can include it in the debt.
Right.
They'll pay some interim interest. So interim interest is paid from the closing date through the end of the month. That allows them to then skip the next month's payment. Okay, so depending on when you close during the month, you'll have some prepaid interim interest. And there are a lot of people that still believe it's better to close at the end of the month. Okay, because there's less days of interim interest. But what happens then is it pushes your monthly payment to close to a month away. Versus closing the beginning of the month where you've got more days of interim interest, but almost 2 months before you make your first payment.
Right.
All right. So from my standpoint, it really doesn't matter when you close. I don't recommend that they wait till the last minute in the month to close, because a lot of attorneys are booked up at the end of the month.
Yes.
Okay, so close when you want to close on your schedule. Okay?
Right.
And then the client's going to shop for homeowners insurance. So homeowners insurance is really their decision on who they want to use to insure the home. Typically best to bundle your home and auto, so whoever they have car insurance with is a great place to start. But the premium on that is going to depend on their credit score.
Right.
It's going to depend on how much they want to insure the home for. They have to insure it for at least the purchase price. It's going to depend on whether they've got, who knows, antiques, a car collection, tools, whatever. If they want to over-insure the home, that's going to affect it.
Okay.
So it's very personal for that client to go out and get a quote on homeowners insurance.
Right.
Okay. If they don't have a preference, we have a service that will send them some quotes. So if they prefer that, we can generate quotes for them. Okay. I think they get 3 different quotes through that service, and they can pick the one they like.
Okay.
And then they're going to have attorney fees. Okay.
Right.
So attorney fees, you're looking at title search, recording, some other fees. And every attorney seems to be a little bit different on what they're charging, overnight fee or not overnight fee. The big thing is title insurance, which a lot of clients don't understand title insurance. So the lender requires title insurance that covers their loan amount. So whatever they're borrowing needs to be covered with a lender's title insurance policy.
Right.
And that's really, it's a look back from the closing backwards in time to make sure that there's a clear title. So they go to closing, the attorney issues the policy to the lender and the client saying, you've got clear title, you can own the home. Okay. The owners is an optional part. Okay. Owner's policy, then it covers them from the loan amount up to the purchase price. And that goes forward in time. And it's great. It's typically fairly cheap, and it covers them against unforeseen things. Okay, it covers them from unrecorded right-of-ways, unrecorded mortgages, unrecorded heirs, protects them against American Indians coming back to reclaim land, which happened in Rock Hill. But it offers a lot of protection for a little bit of money, and it covers them for as long as they own the home, even if the mortgage has been paid off. Really, the big advantage right now is because we are looking at getting those rates coming down on for us, and a refinance boom probably in a year. They'll get a half price reissue policy when they go on the refinance end of things. And so, there's some real advantages to doing that.
And here at Broadwater-Toole Realty, we recommend an owner's policy.
It makes sense.
Yes. PMI and MI. I know a lot of people is like, why do I have to pay this insurance?
Sure. So PMI, private mortgage insurance, was created so that people didn't have to have a 20% down payment. 20% is that magic number. I don't know whoever came up with it, but at 20%, if you have a 20% down payment, you don't have to have private mortgage insurance. If you don't have that, well, the lender's at risk. So on the behind the scenes kind of things, on those conventional loans where you typically have PMI, those loans are guaranteed by either Fannie Mae or Freddie Mac, and they will guarantee 80% of the purchase on that new loan. So if somebody defaults on the loan, the lender is covered for 80%. If the client didn't put down the 20%, then the lender's at risk for a certain amount. And so that private mortgage insurance was created so that somebody can come in with less than a 20% down payment and still purchase a home. But the lender's at risk. So it's basically a policy that they're taking out on themselves to guarantee to the lender that if I mess up and you have to foreclose on me, then your investment's covered. Okay, so that's PMI. MI is a little bit different. It's on the government loans. So USDA and FHA, they have, FHA has MI. Okay. USDA will tell you they don't have private mortgage insurance or MI. They really do. They call it something different. Okay. But those are on for the life of the loan. And that MI is figured on the remaining balance on the mortgage. So every year as the mortgage balance goes down, the MI is going to decrease a little bit but it stays on for the life of the loan. So somebody either has to refinance, sell the home, pay off the mortgage in order to get rid of the PMI, or the MI.
The
Sorry.
MI.
Yeah. The USDA has what they refer to as a annual fee. The difference there is really that on an FHA, that MI is paid into the mortgage each month, and it's paid out of their escrow account to an MI fund.
Okay.
USDA, they handle things themselves. They're a little bit different. It's paid monthly into that account, but it's only paid out once a year.
Okay.
Okay, so that they can call it something different, and they can say that we really don't have MI, we've got an annual fee. It's really kind of the same thing. Okay, but it's basically protecting that program if somebody defaults on it to make up for losses that would be incurred during the foreclosure.
So on the conventional, so we know for FHA, it stays on the life of the loan. For conventional, once you hit that 20% magic number, will they automatically drop it, or do you have to call and they drop it?
So when a client goes to closing, there are going to be two lines in the sand. So in their closing package, it's going to say, okay, at this date, you're going to be at 80%, and you can request that the mortgage insurance be dropped. Typically, a year later, you're at 78%. And at 78%, it has to be automatically dropped. Now, that is based off of what's currently. So if they're buying a home for $200,000, that calculation assumes the house is always worth $200,000.
Right.
But as homes appreciate, then you're going to reach that 20% equity much faster.
Right.
So somebody that has a 5% down payment, typically they'll be looking at paying PMI for approximately 7 to 8 years.
Okay.
But if the home appreciates at 4% each year, really within about 4 years, they've gotten that equity where they're able to contact and say, okay, I think I'm there. I think my house is appreciated enough. My loan balance is paid down far enough that I've gotten 20% equity.
Right.
They can call and request that it be dropped. Now, more than likely, what they need is they need a new appraisal. Because the lender wants to make sure, okay, you're actually there.
Right.
We've seen more and more where lenders are moving to these automated value models, AVMs, where they can pull up statistics on homes that have sold, and it'll generate a value and say, oh yeah, you're way beyond the 80%. You can drop the PMI flat on appraisal. Okay. It seems like technology is moving us in that direction, but right now, majority of the time, we're going to require that a new appraisal be done.
We've asked him so much. He's spilled his guts on so much today that's my last question. Is there anything you want to, that may not have been discussed during this period, that you want to make sure that the viewers know about?
Sure. One thing is I'm always available. My wife hates it. She's learned to deal with it over 31 years. But I answer phone calls at home. I usually check my emails late into the night. But I'm there for clients. And like I said, my goal is really to create that homeowner. You know, it's not just to close a loan and get paid for it. I'm invested in my clients. I want to see them succeed. I want to see them build wealth. And so that's really where my goal is to get somebody into a home that never thought they'd be able to be able to buy a home. And we've seen that. I've worked with clients sometimes for years in getting their credit where it needs to be so that they can have that dream of home ownership.
Right.
And so that's really, you know, for me, that's my personal goal. Okay. As a company, we have teamed up with the South Carolina Gamecocks. And we've got a giveaway for the, I think, October 25th game with Mizzou. So a couple game tickets, parking passes. We're going to have some other great prizes. So if your clients would be interested in signing up, we put a link in the podcast.
Absolutely.
They can sign up and hopefully win the tickets.
Yes. And how would somebody reach you, Matt?
So they can reach out to me on my cell phone. That's typically always on at 803-634-0605. But if it's during business hours, call the office. Margo will pick up the phone almost every time. That phone number is 803-644-4010. If they wanted to just reach out to me via email, it's pretty straightforward. It's mhunter@assurancemortgage.com. Like I said, I read those in the late nights.
Right. You responded to me late.
Yep.
Yeah.
And so, we're pretty much always on.
Yeah. Well, you heard it here first. Thank you for listening and viewing Market Talk with Broadwater-Toole Realty. We are so happy that Matt was able to come and dispel some information to us. So now when you go in to buy a house, you know right from wrong. You know what's accurate, what's not accurate. Some of the nuggets I took today was your credit. Make sure you stand on top of your credit. You don't have to pay someone to do that. Reach out to Matt and start the process. And if there's something additional needed, he will talk you through it. Thank you for joining.
You're welcome.
Thank you for joining Market Talk 5th episode with Broadwater-Toole Realty and Matt.